Hi everyone, my name is Ben and this channel is dedicated to all things personal finance related. So in this video we're going to be talking about how to invest in gold. We're going to start with some of the benefits of investing in gold, then we're going to get into how to actually get started investing in gold, as well as some of the drawbacks, some of the negative sides of investing in gold. Now, while we're going to be talking about investing in gold, particularly in this video, the concept remains the same no matter what type of precious metal you're interested in investing in. Whether that's gold, silver, platinum, palladium, etc., the concept is going to be all the same. So realistically, why should you start investing in gold? Well, probably the biggest reason that people invest in gold is as a store of wealth. Gold is a natural hedge against inflation. You see, the problem with paper money like this is that this is literally just printed down at the Federal Reserve. The government just wills these bills into creation. And at any point in time, they can print as many of these as they want. And basic supply and demand says the more of these there are in existence, the less each one of these is worth. This concept is known as inflation. And inflation has eroded over 96% of the value of the US dollar bill since the Federal Reserve was introduced in the early 1900s. That means that $1 back in the early 1900s is actually worth more than this $20 bill is today. That dollar bill a long time ago would buy me much more stuff than this $20 today, because the government is consistently printing more and more of these. But the government can't just will a pile of gold into existence. There's only a limited amount of gold, and so that is going to serve as a natural hedge against inflation. And the other reason that people typically invest in gold is to further diversify their investment portfolio. Now, a lot of times when we think about diversification, maybe we're realistically just diversifying our stock portfolio, which is not true diversification. Even a well-diversified stock portfolio, like maybe you own some index funds like Vanguard's VTI, their total index fund, that fund has over 3,500 different companies in that fund. But when coronavirus kicked off and the economy started tanking, even that well-diversified index fund lost 35% of its value in a very short amount of time. Now, gold price tends to move in opposite directions to the stock market. So when the stock market is crashing and the world is falling apart financially, the price of gold tends to skyrocket. And when the economy starts to recover and stocks start doing well, then the price of gold tends to fall back a little bit. So it's sort of this counterbalancing situation. So even in a worst case situation like a stock market crash due to coronavirus or whatever happens in the future, owning some gold will protect your overall net worth, because as that stock portfolio falls, the value of your gold will inherently tend to rise. So how does one actually get started investing in gold? Well, the first way, and the one that people most often think about when it comes to investing in gold, is just to go out and actually buy some gold. This is the physical asset itself. Now, this can be bought at your local coin dealership or online from reputable sources like jmbullion.com. But the biggest thing when you are buying actual physical gold is make sure you're buying it from a legitimate, reputable company. I would not go buy some gold from a street vendor or a pawn shop or anything like that, because realistically, they say it's gold, but you never really know what you're going to get. So make sure you're buying it from a reputable company. Now, when you're buying gold, usually coins start out at roughly about an ounce and can scale up from there into different forms like gold ingots or gold bars. And bars can go all the way up to about 400 ounces, like the ones that you see in all the bank robber movies. Now, when it comes to buying physical gold, you're going to hear what's referred to as the spot price. The spot price is the fair market value for 1 ounce of gold. Now at the time of making this video, the spot price of gold is about $2,000. That means that for every 1 ounce of gold that you have, it is worth $2,000. Now remember those big bars of gold that were 400 ounces? Well, you can do the math. 400 ounces times $2,000 per ounce. That means every one of those gold bars is worth about 800 grand. Now you know why they make so many movies about bank robbers stealing bricks of gold. But it's important to note that just because the spot price of gold right now is about $2,000, that doesn't mean that if you buy a gold coin that you're only going to spend $2,000. You see, the metal itself is worth $2,000, but whatever coin dealership or website or whoever sold you that gold, they also need to make a profit. So typically you're going to pay a premium above the spot price. And this varies depending on where you're buying it from. But typically you're going to pay anywhere from about 1 to 5% over the spot price for your gold. Now typically this markup is going to vary depending on not only who you buy it from, but how much you're buying. So smaller quantities of gold, like a 1 ounce gold coin, typically have the highest markup. And if you're rich enough to buy larger quantities, maybe multiple coins at a time, or a gold bar or ingot, then you're probably going to pay a lower percent premium on that transaction. Now if we look at this screenshot from jmbullion.com, you'll notice this 1 ounce gold coin on the left is selling for about $2,037, while the exact same coin right next to it is selling for $5 more. Why is that? That's because the coin on the right is the 2020 version of this coin, whereas the coin on the left is going to be the same amount of gold, but from any random year. And this is going to be sort of the collectible markup. So people that actually collect coins and are trying to complete sets of these things, that's why the coin on the right is worth more, because you know specifically what year you're getting. If all you're interested is just purely investing in the gold itself and you don't worry about the collectible, if you're not trying to complete a set, then don't worry and don't pay these additional markups. Just go for the cheapest coin that you can get that has the quantity of gold in it that you're looking for. Now when you're buying gold at a coin shop, obviously you're just going to take ownership of the coin right there on the spot. But when you order a coin online, they're actually going to ship it to you, usually in some sort of very discreet, nondescript like FedEx or something like that. That way people aren't stealing it off your front porch or anything like that. But they're going to send it to you in the mail. Now the next way to invest in gold is sort of like stocks. You're going to own shares of a company, and that company is going to own and store the gold. So as the price of gold increases, the amount of gold that this company owns is going up in value, and therefore the stock is going to also go up in value. So it's a direct correlation to the spot price when you're investing in these types of products. Products like stock ticker GLD. Now investing in stocks like this has some pros and cons as opposed to owning the physical gold itself. By far and away the biggest pro is that it is very easy to trade from the comfort of your own home. This makes this asset very liquid because you can theoretically buy and sell this product multiple times throughout the day as the stock price fluctuates. Now the one downside about this is that you're not taking physical ownership of the gold itself, and that's why this is sometimes referred to as paper gold. Now some people feel that if you don't physically have it in your hand, then gold is basically worthless. And the idea behind that is, let's say a worst case doomsday zombie apocalypse happens. If you have physical gold in your hand, you can barter and trade and sell that to other people for whatever types of survival items that you might need. But when the zombie apocalypse happens, nobody cares about your gold stocks. Like, you're not going to be able to trade that for food, water, and guns. And that's why a lot of people prefer to have the physical gold on hand as opposed to having these paper gold, these stocks of gold. And the last way to invest in gold is to invest in the companies that are actually mining the gold, the ones that are actually digging this stuff out of the ground. Now this could be companies like stock ticker GOLD. Previously we talked about GLD, that's a completely different one. That company actually holds and owns the gold. GOLD, that's a mining company. Now when you're investing in mining companies, it's obviously very important that you invest in a wide variety of mining companies and not just one particular company. So you're going to want some sort of an index fund of mining companies, something like GOLD. And it's also important to note that the stock price of these companies is not directly correlated to the spot price of gold. So as the spot price of gold increases, obviously that's very beneficial to these mining companies, but it's not a direct correlation because at the end of the day, they still have to be able to pull gold out of the earth and sell it. So if for whatever reason they just don't find any gold recently, maybe the mine is running out or whatever the case may be, an increase in the spot price does not necessarily mean an increase in the price of the stock. Just like a falling spot price does not necessarily mean the stock price is going to fall. Maybe they hit, the jackpot and they find a ton of gold, in which case the stock could still go up in value even though the spot price is currently declining. So what are some of the downsides to investing in gold? Well, probably the biggest downside is at the end of the day, it's basically just a rock. It's a really heavy paperweight. It just kind of sits there looking pretty and doesn't do anything. So unlike most types of investments like stocks or bonds, it does not generate any dividends, it does not generate any interest or cash flow, revenue. It just sits there. This means the price of this product is purely speculative based on supply and demand. The more people that want gold at any one particular time, the price is going to go up. As demand drops for gold, the price is going to go down. And the next negative thing about investing in gold is storage. I mean, realistically, gold is very expensive and it's easily stolen. So once you own the gold, now you have to protect the gold. So you might want to invest in some sort of a safe or hide it throughout your house or bury it in your backyard. Whatever it is that you're doing, you got to make sure that nobody else finds out that you have this because you're probably going to get robbed. And while gold is relatively expensive, so the amount of gold that most investors are going to actually have on hand is relatively small and is not going to take up a lot of space. If you're a more wealthy investor, now it's starting to take up more and more room, so you got to think about bigger and bigger safes. And that may not be such a problem for gold, but the price of silver is currently about 70 times less than the price of gold. So if you were going to buy silver coins or silver bars, then it would take 70 times more room in your safe just to house all of that silver. And while you can store your gold in something like a safe deposit box at the bank, that means you got to pay for the box itself, and you probably got to pay some insurance to house that in the bank, etc. And so it's just a little bit more cumbersome than just simply having stocks or money in the bank that's just simply FDIC insured against losses. And the last thing that kind of stinks about owning gold is the taxes that you're going to pay on this that are a little bit higher than most investments. So hypothetically, if you buy gold today for $2,000 an ounce and you later sell it at some point in the future for $3,000, then you made $1,000 of profit and you're going to get taxed on that profit. Now for most investments, if you hold that investment for 1 year or more, you get taxed at a very favorable tax rate referred to as the long-term capital gains tax rate. And for most people, that's about 15%, or if you're really rich, you might pay up to 20% for this long-term capital gains. But gold, on the other hand, does not follow these rules. Gold is taxed as a collectible, much the same way things like baseball cards or artwork is taxed. And the tax rate for collectibles actually goes all the way up to 28%. So you could theoretically be paying almost twice as much in taxes on any kind of profits that you make if you're in this 15% tax bracket for long-term capital gains for things like stocks and bonds and that kind of stuff versus 28% for this gold collectible tax rate. So that can have a pretty big impact, especially if you're putting significant amounts of money and your investments into gold. So that's going to wrap it up for us today, folks. If you found this video useful, be sure to subscribe, leave a comment down below in how investing in gold is going to help you achieve your financial dreams. And as always, I'll see you all again next week. Thanks.